Well, thank you very much for inviting me to spend some time with you today. It's been a long journey from the beginning of Bollinger Bands to the wide acceptance that they have today. And along that journey, I've explored a lot of different pieces of technical analysis. We're going to talk about some of that today. We have relatively limited time, so I'm going to ask you to hold your questions until the end of the session. We will have some time then, but because of the way my screen is set up right now, I can't see the dialog box that the questions come in on. So we're going to basically have two parts today. I'm going to talk a little bit about Bollinger Bands and how they're formed, put together, how to build a chart with Bollinger Bands, and then we'll talk about combining Bollinger Bands and candlesticks, which is a very old and deep interest of mine. In fact, my interest in candlesticks goes back to the time in the U.S. markets where really there were no materials available on candlesticks or Japanese technical analysis of any sort. Today, obviously, you have access to a huge amount of information about not only Japanese but other East Asian styles of technical analysis, and I think that's a great help. But as I say, we're going to start with an exposition on Bollinger Bands, how to build a Bollinger Band chart. We'll touch on a couple of indicators, percent B and bandwidth, and how they're constructed, and then we'll talk about using candlesticks and Bollinger Bands. So the first chart that most people consult is a simple line chart. It's just created by closing by connecting the dots between closing prices. And although it does give you some sense of trend, you can see that we're falling on the right-hand side and rising on the right-hand side. This conceals a tremendous amount of data. So we're going to start with this basic data set. We're going to see how we can change this chart by adding pieces to it one by one to create a more appropriate visual environment for us to use our pattern recognition engines. That is the pattern recognition engines that we were born with. The first thing that we're going to do is perhaps one of the most important parts that I'm going to talk about today, and the part that most of you are just going to go, nah, gee, I don't want to do that. I like it just the way it is. That really doesn't make any sense for me. And that is, we're going to change the y-axis of this chart, the price axis of this chart, from an arithmetic scale to a logarithmic scale. This way, an equal move in distance on this chart has an equal impact on our portfolio, regardless of whether we're at the bottom of the chart or we are at the top of the chart. When we're at the top of the chart...
John, let me interrupt you just a quick second.
Yes.
Move your mic about 1 more inch away from your mouth.
Move my mic 1 more inch away from my mouth. Okay. How's that? Is that a good distance now?
Yes, that's perfect.
Perfect. Okay. So by shifting from the arithmetic scale to the logarithmic scale, we present the true economic value of a change in price, regardless of price level on the chart, to our portfolio. This is especially true if you are trading things that are low-priced, stocks in the $5, $7, $10 range. As we get up into the higher-priced stocks, this is not as much a problem as it is for the lower-priced stocks. But I virtually always shift my price scale to logarithmic axis so that I get a real sense of the move on a chart that is going to have the similar impact in my portfolio. So the next thing we're going to do is try to expand upon our data set here. Here we're showing only the closes, but we have the open, high, low, and close available to us, and by adding those, we can get a bit of a better view of what's going on. These are, of course, classic Western bar charts. Each bar represents a period of time. In this case, it's a day. The height of the bar runs from the high price of the day to the low price of the day, with a tick to the right for the closing price. I know, talking in the Candlestick Forum, I'm preaching to the choir when I say that this is a nice presentation of the price data, but that it can be improved on. Basically, the Western presentation stresses the range with a minimal importance being attached to either the opening or closing price. So we can shift to candlesticks, which, as you well know, highlight the relationship between the open and the close. In the presentation that I'm using here, the body of the candle is filled in black when the close is lower than the open, and the body of the candle is filled in white when the close is higher than the opening. The thing that I personally don't like about this presentation is that the width of each candle is different for the body and for the whiskers. That always bothered me. I thought it inappropriately de-emphasized the range outside of the opening and closing. And I had the idea that somehow we could improve upon this idea. And we could improve upon this idea by using color. So in essence, what I did is I took the concept of a Western bar chart and a Japanese candlestick chart, I added color, and came up with a new charting style. You can see it on the background in this slide, but here we have an example of this charting style as applied to some examples here. On the left, we have a chart where we close higher than we open. So the center of the bar, which would be the body of the candlestick, is colored in green. The second from the left, we have a chart, a bar where we close lower than we opened. So the center of the candlestick is colored in red. The third from the left, or the second from the right, is a chart where we opened at the absolute low of the day and closed at the absolute high of the day. And the right-hand bar is a bar where we closed at the low of the day after opening at the high of the day. Of course, on the bars on the left, the blue portion that's filled in is the portion that would be the whiskers of the candlestick chart. Or the wicks, as they're called. The Japanese actually talk about them as whiskers, as in a cat's whiskers, for whatever reason. I'm sure that there's an appropriate explanation, but I don't actually know what that is. One thing I did want to point out to you is something which people don't often realize, is that when we look at a candlestick or a Bollinger bar like this and we see a green body, it gives us a piece of information that you may not be aware of. It tells us the likely order of which was reached first, the high or the low of the day. When the body of the candlestick is green, that is when we closed higher than we opened, chances are about 90% that the low of the day was recorded before the high of the day. Likewise, when the body of the candle is red, the chances are about 90% that the high of the day was recorded before the low of the day. Those of you who are interested in building trading systems and analyzing the performance of trading techniques will realize that this can be a very useful shortcut when trying to figure out if stops were hit or entries were enabled based on when the highs and lows were created. So here's that same chart, now colorized with this these items I call Bollinger Bars, combination of Western candlesticks and that is Western bars and Japanese candlesticks. I find that this red and green coloring is very helpful, and that the equal width of the bars across the entire range of the bar, whether it's the body of the candle or the whiskers, is much more aesthetically pleasing to my eye, and it makes the pattern recognition process somewhat easier. So I've adopted this as my charting style of choice. So the first thing that we're going to add to this chart is a moving average that will give us some sense of the trend of what's going on here. But before we do that, we're going to start by adding some sense of supply and demand. And for that, we're going to add the traditional volume plot at the bottom of the chart. One of the themes that we're going to focus on today is relativity. That is, whether prices are relatively high or low. And here we're going to need to focus on whether volume is relatively high or volume is confirming price action. So in order to do that, we're going to have to put on some sort of reference for volume, and that's going to be a moving average of volume. In this case, it's a 50-day moving average. By definition now, volume above the average is high volume, and volume below the average is low volume. So you see that red line that I've just added to the chart? Imagine if you were to just grab the ends of that line and pull it until it was straight. Well, we can do that mathematically with a very simple operation, and the result is called normalized volume. So literally what we've done is grab that average and pull it straight. That average is now the red line, and we call this normalized volume. Volume equal to the 50-day moving average is now 100. Volume half the 50-day moving average is now 50. Volume double the 50-day moving average is now 200. So here's the formula that we used to do that. We just took volume and divided by its 50-day moving average and multiplied it by 100. Now we can easily say normalized volume that normalized volume greater than 100 is high volume, or normalized volume normalized volume less than 100 is low volume. So again, as we go through our process today, in every turn we're going to try to move to these relative measures and away from absolute measures so that we don't have to do any guesswork, so we can just ask the computer what's happening here. But we can improve upon this a little bit because, is normalized volume of 101 or 102 really high volume? A normalized volume of 98 or even 95, is that really low volume? I don't think so. So we can improve this analysis by using a threshold. So here we've just changed our rule a little bit. We say normalized volume greater than 125 is now high volume, and normalized volume less than 80 is now low volume. Now, notice that those numbers don't seem to be reciprocal, but in fact they are. The inverse of 125 is 80, or 1.25 is 0.8. And so that's the correct idea. Most people would take 25 and subtract it from 100 to get the low range, 75, or add it to 100 to get the high range. But in fact, this is a ratio function, so we need to take the reciprocal 1 over x, and that works out to be 125 or 125 and 80, or if we were to use 150, that would be 150 and just checking that, and 66. So you can see it's not a direct relationship, but so when we have the place where it really starts to make sense is when we start to get into some really volatile times, and we say volume of 200% of average is high volume. Well, then you want to use volume of 50% of average as low volume. So you can see the numbers scale in a ratio manner. So the first thing we're going to do in constructing Bollinger Bands is add a moving average that's going to serve as the middle band. In order to do this, we're going to select a moving average that is descriptive of the intermediate term trend. This is almost certainly going to be an average that's too slow to serve as a good crossover moving average for, say, a simple moving average crossover trading system. In fact, a good place to start is a moving average that's roughly twice the length of a good crossover moving average. In our case, we're going to start with a 20-period moving average, and you can see it works pretty well here. It rises for most of the time that price is rising and declines for most of the time that price is falling, and that's exactly what we want. I can't emphasize this enough. We want an average that is going to serve as the base of trading bands. We want it to be descriptive of the intermediate term trend. So that's what we have going here. And I give you now a little idealized image of how to select that moving average. So the chart you see now has 4 lines on it. The black line is just some synthetic data. On the left-hand side of the chart, it falls by 1 unit per period until it reaches the bottom at 50. And then it rises for exactly 20 periods, reaching 70, then falls for 10 periods, reaching 60, and then starts rallying again to the right-hand side of the chart. Again, the daily move is always exactly 1 tick. So this concept of using synthetic data for analysis is a very powerful concept, one which has served us very well, but unfortunately it's beyond the scope of what I can chat about today in the short time that we have with each other. I'll point out here that the ideal moving average for our purposes is the green moving average. It fits the data perfectly. It crosses the price structure early on in the transition from a bear market to a bull market, and it provides support at the first pullback within the new bull market. And in fact, it turns up on the very first day up after the retest. So this is exactly the perfect average. The red average, on the other hand, is too short. It gets crossed very quickly after the low, but gets whipsawed during the pullback, and then finally turns up way too late in the process. Almost 12 days after the intermediate term pullback. And finally, the blue line is obviously much too slow. It turns up last of all, long after the entire bottoming process has been completed. So if you look on your charts and find major inflection points in the sorts of things that you trade, you can adjust the moving average that you use as a base for trading bands using this sort of technique to see whether you have a moving average that's too short or too long to serve as a proper base for trading bands. So now that we've got the moving average, we can construct Bollinger Bands. The middle band is simply going to be the moving average. It'll be a moving average of a variable called length. We'll talk about what length is in just a moment. The upper band will be the middle band plus a variable called width. We'll talk about that again in just a moment, times a quantity called volatility, which is simply the standard deviation of the same data that was used in the moving average. The lower band is going to be that variable width again times that same measure of volatility, standard deviation. So in this way we create a middle band, a band above, band below. So here are the kind of defaults to fill in the information so we can construct these bands. Volatility is the standard deviation of exactly the same data that is used for the average. And length, for our purposes, the default of 20 works pretty well for U.S. stocks, and width of 2 works pretty well for most applications in the financial arena. You may find that you have to adjust these to suit your purposes, but I think you'll find that 20 and 2 serve as pretty good defaults. One thing I'm always asked about these is what type of average we use. We use a simple moving average, and I suggest that you do 2. It seems to work pretty well, and we haven't had much in the way of problems with it. But some people are convinced that an exponential moving average will serve their purposes better, and perhaps it will. I would only say that if you are in fact going to use an exponential moving average, you should use it both for the middle band, that is changing the middle band from a simple moving average to an exponential moving average, but you should also use it for the calculation of volatility. Inside that calculation of standard deviation, the value of the average that's used there should now be the value of an exponential average. So with that, we have our chart more or less complete for the moment. We'll have our nice colorful version of candlesticks. We have volume that has been normalized by dividing by its 50-day moving average. We'll have a measure of trend running through the center of the chart. That's our moving average. And we have measures of high and low. Those are the upper and lower Bollinger Bands. You see the upper band there in red, the lower band beneath it in green. So, and this is the key thing about Bollinger Bands. This is what they actually do. It's actually true of all trading bands, not just Bollinger Bands, but if you want to use Donchian bands or Keltner bands or percentage bands or some other sort of trading bands, they all serve the same purpose. They define whether price is high or low on a relative basis. By definition, prices are high at the upper Bollinger Band, and by definition, prices are low at the lower Bollinger Band. It seems a little confounding to people, but that, in fact, is all that Bollinger Bands do, is provide this definition of relatively high and relatively low. So, and it's this key of relativity that I think is important to this successful approach to technical analysis. And I think it is going to be the key to your successful use of candlesticks as well. A doji or a morning star or 3 crows or what have you, whatever formations you like to trade, I think you'll find that there's a great deal of value in considering whether those formations are occurring relatively high or relatively low in the price structure. A top formation that occurs relatively low in the formation probably not going to be of much use to you. And a bottom formation that occurs relatively high in the price structure, again, is probably not going to be very much use to you. But by using Bollinger Bands, you can quickly sort that out. So we have this concept of relativity that I think is so important to successful technical analysis. I'm just going to read these bullet points as they are to emphasize this, because I think it's something that people don't think about a lot, especially when they get caught up in using concepts like Eastern technical analysis concepts, where the formations that we see seem to exist in their own realm, not relative to the price structure in many times. So relativity is key to this sort of technical analysis. Absolutes are eliminated. We no longer worry about absolutely high or absolutely low. We only worry about relatively high, relatively low. And the market is used to answer questions whenever possible. And this is the key to my great cause in trading, which is to eliminate the emotions from the trading process. People who have been in this my trading room here, or who have seen me on television during times of crisis, know that I tend to be pretty cool when it comes to the world is falling apart around us, and various Chicken Littles are running around screaming that the sky is falling, or the sky is rising, or the sky is going to rise forever, as the case was in the late 1990s. I tend not to get involved very much in that because I have this relative framework to work within, and that sort of framework discourages having emotions like that in the marketplace. So here's a basic example of what this analysis technique is all about. I've introduced a third clip on the chart here. It's 21-day intraday intensity. It's simply a supply-demand calculation that is based on where price closes in each day's range. It was created by an economist by the name of David Bastian when he was in the Army. Actually, he was in Fort Dix, and he had nothing to do. He'd always been interested in the stock market, so he spent many months working out these supply-demand indicators, and he came up with this one called intraday intensity. Some people call this accumulation distribution, but that is in fact a different indicator. That was written by Larry Williams. This is intraday intensity, and the formula is closely related to the idea of where the market closes in each trading day. The intraday intensity will start to build up positive values if we start closing near the highs. It will start to build up negative values if we start closing near the lows. And it incorporates volume into its calculation. So a rally that occurs on low volume will produce very poor levels of intraday intensity, but a rally that occurs on very high levels of volume will produce very high levels of intraday intensity. So taking a look here, we see I've circled two areas on the chart. The first one is a tag of the upper band. You can see that big green candlestick sticking up there that breaks the upper band. And if you look down directly beneath it, you'll see intraday intensity is a negative value when that tag of the upper band occurs. By the way, a tag of the upper band is simply when any part of the bar touches the upper band, and the tag of the lower band is when any part of the price range is equal to the lower band. So we go along for a period of almost a month during which we consolidate. Price pulls back to the moving average. We go sideways. And you can see this time it's a different story. This time the indicator is strongly positive. So this breakout is a buy signal that leads to a huge rally. So the key here is this concept of confirmation and non-confirmation. In the first tag of the upper band is a non-confirmed tag of the upper band. The second tag of the upper band is a confirmed tag of the upper band. So let's shift that logic a little bit. Let's look at the lower band. I hope you can see my mouse here. Is that visible to everybody? Little mouse pointer? Anybody? Hello?
Yes, we can see that.
Okay. So this bar right here is a tag of the lower band, and you can see the indicator is strongly negative. So this is a confirmed negative tag of the band. There's another one over here. So at this stage of the game, the trend is still downward. Here, we almost tagged the lower band, but the indicator is very strong. So this is a non-confirmed tag of the lower band. So here you have a set of flips. In the first oval, an upright oval, you have a confirmed tag of the lower band and an unconfirmed tag of the upper band. In the second one, you have an unconfirmed tag of the lower band and a confirmed tag of the upper band. So I think you can see where we're going with this. By having this nice definition of relatively high and relatively low, we can compare price action to indicator action in a rigorous manner and arrive at unemotional trading decisions, and that's really the key for me, is this ability to arrive at unemotional trading decisions. So the first indicator that we're going to talk about today that is derived directly from the Bollinger Bands is %B, and it tells us where we are in relation to the bands. So the formula for %B is lifted directly from the formula for stochastics. The formula is the last price minus the lower band divided by the upper band minus the lower band. So what we've done is just take the formulas for stochastics and take in place of the periodic high, we've substituted the upper Bollinger Band. In place of the periodic low, we've substituted the lower Bollinger Band. So %B will be a value of greater than 1.0 when we're above the upper band, and it will be less than 0 when we're below the lower band. At the middle band, it will be 0.5, and at the upper band, it will be 1.0. At the lower band, 0.0. There's another formulation for %B that puts 0 in the middle and 1 at the upper band and minus 1 at the lower band. Some people like that. But since I lifted the formula from stochastics, I thought people would want it to run in exactly the same scaling as stochastics, because it was a scale that they were familiar with. So I left it in that scaling. So here we see %B. And the key here is we're going to look at three lows. Here's the first low, here's the second low, and here's the third low. And you can see %B is in a rising trend across all three lows. Remember, we have a confirmed tag and an unconfirmed tag here, and then an unconfirmed tag and a confirmed tag here. So that is accompanied by a rising trend in %B, and that is indeed a very bullish configuration. We'll often see this exact configuration as a stock is transitioning from a downtrend to an uptrend. The second indicator that we're going to talk about today is bandwidth. Bandwidth simply tells us how wide the Bollinger Bands are. It's comparable across time. That is, you can compare this week's bandwidth to last week's bandwidth to last year's bandwidth, or even last decade's bandwidth if you want. And it's comparable from issue to issue because we've taken the trouble to normalize it. So here's the formula. It's simply the distance from the upper band to the lower band divided by the value of the middle band. The purpose of that division at the middle band is to normalize bandwidth so that comparability is maintained. For most stocks, 5% is pretty typical bandwidth. Some stocks will run higher on average, some stocks will run lower on average. The easiest way to find out what the normal is for any given stock is to run linear regression on %B. Almost all the technical analysis software will let you do that sort of thing now. And whatever the level of the linear regression, and I do mean a long-term linear regression, say something that covers a couple of years worth of daily data, that'll give you a really good sense of what the normal value for %B is, for bandwidth is. So, and whatever that is, half of that is very low bandwidth, and several times that, say 3 or 4 times that, is pretty high bandwidth. So here we have situations in which bandwidth is pretty low. For this stock, low bandwidth is around 7 or so. Average bandwidth over time is about 15. So again, you have that basic sort of relationship of low bandwidth is kind of half of what average bandwidth is. And you see two places on the chart where that was really true. One on the left-hand side, one on the right-hand side. The left-hand side precedes a pretty steep decline in price, and the one on the right-hand side follows a consolidation that leads to another leg up. I specifically point at the one on the right-hand side because it is so popular in idea with people who trade high relative strength stocks. This little consolidation that you see there in this time from roughly the middle of June until we break out again is known as a relative strength pivot. And often during one of these relative strength pivots, you'll see bandwidth fall to a very low level and then followed by a breakout, indicating that the uptrend has resumed. Those people who like to trade these high relative strength stocks will all know about this sort of relative strength pivot, although they may know it by any number of other names. The fellow who taught it to me always called them relative strength pivots, and the reason he did so is because if you look at the relative strength line for the stock, that is the ratio of the stock to the stock market, you'll see it flattens out and forms a little consolidation pattern while the price is doing that, and then when it turns back up, he takes that little consolidation pattern there, that little flag on the relative strength line, and calls it a relative strength pivot. I think it's a very powerful key. One of the keys to that is what we call a squeeze, which is a very low periodic value in bandwidth. The opposite of squeeze is a bulge, and the bulge is most useful for forecasting the end of a trend. Often when you have a primary trend that's very strong, bandwidth will get very wide as the sheer power of the market, either to the upside or to the downside, will drive the bands quite far apart. And when you get that turn down in bandwidth that you get like right in this area here, you're in the situation where you have a warning that this downtrend is at a potential end. Then, of course, we go through that series of confirmed and unconfirmed tags and the rising trend in %B to tell us that, in fact, this was the end of the downtrend and that we are working on beginning a transition first through a base and then into a sustainable uptrend. So, a little bit about Japanese candlestick charting. I'm one of the oldest Western practitioners of various Japanese candlestick techniques, simply because in my very early days, 1983 or so, somebody dropped a Japanese chart book on my desk. And I looked at it and I said, wow, that's really interesting. And it was one of those Japanese chart books. They're called golden books. It was, they have any number. I think this one had 5 different sorts each stock, including one of which was candlestick chart. So I decided I really wanted to learn a lot about that. But it was the very early 1980s, and it was very hard to learn anything about Japanese methods of technical analysis, including candlesticks. Basically, it was trader to trader, and if you knew somebody who knew, you were in luck. If not, you just weren't. I was really lucky because I was working at the Financial News Network at the time, and we had some Japanese traders come through the offices of FNN, and I was able to question them about their techniques, and they taught me in the beginning about how they did what they did, and that's what got me started. The first book that I ever got my hands on was actually smuggled into this country by a Chicago floor trader. He had heard that Sheiki Shimuzu's book, The Japanese Chart of Charts, was being translated in English, and he actually flew to Japan and bought a slew of them before they were imported to the U.S., stuck them in his suitcase, flew them back to the U.S., and sold them to the poor suckers that wanted to know something about charting for twice the list price of the book. The book list price was $20, and he sold them for $40 in addition. So that's how I got my hands on my first book, and it's really still a very good book if you can find it, and you can. There were quite a few in print. They're not that hard to find. You can chase them down on like abe.com, which is a book exchange, or libris.com. Both of those are big used book sites, and you can chase down a copy of Seiki Shimuzu's book, The Japanese Charts, published in 1986 in English. It had been through several editions. Mr. Shimuzu was a very important analyst at a Japanese futures firm, and the name was extremely well known in Japan, but completely unknown here in the States. And the second book that I got was actually written by the Nippon Technical Analysis Association, which was the Japanese technical analysis group. It was published in Japanese in 1986, and that is the copy that I got in Japanese. It was pretty fun to go through and look at the charts and try to figure out what was going on in the book, but it wasn't until 1989 that I got an English copy. So you can see that in the old days, learning about this art was pretty interesting. At the time, I knew a guy by the name of Greg Morris, and Greg was pretty interested as well, and he suffered the same problems that I suffered. Unless you knew somebody Japanese who was willing to teach you, you just you couldn't get to square one. So Greg actually took the step of moving to Japan for a while and studying with a Japanese candlestick master. And he published a book called Candle Power in 1992 by Probus Professional. Again, that's been out of print for a long time, but it's a very useful book, and you can find that used on the internet as well. So there are 3 candlestick books that you probably have not heard of. The first 2 cover quite a bit more than just candlesticks. They cover various Japanese charting methods and various other Japanese technical analysis ideas. And the third one's primarily focused on candlesticks, but it was the first book to tackle the idea of trying to filter candlesticks with Western technical analysis tools. And Greg and I talked a lot about this. We talked about using trading bands, specifically Bollinger Bands. We talked about using other indicators, RSI, stochastics, MACD were the obvious ones, but we both were kind of technical analysis nerds, so we knew about a lot of different indicators. We really started to explore this initially together, but at the time Greg was a very busy guy. He was traveling a tremendous amount, and it was kind of hard to keep in touch with him, so we kind of went our own ways and pursued this sort of analysis. So I became convinced that Bollinger Bands could help in candlestick analysis, and they could help dramatically. I'm just going to touch a little bit on the idea because, frankly, you guys know a tremendous amount more about candlesticks than I do at this stage of the game. Because I went on to focus on Bollinger Bands and the tools and techniques that are related to them. But in 2001, the Japanese Technical Analysis Society, the Nippon Technical Analysis Association, or NTAA, invited me to come to Japan and present a lecture at the IFTA, that's the International Federation of Technical Analysis Conference, that was being hosted in Tokyo that year. And I agreed. And that slide should say combining. Whoops. So that slide should say combining. On combining candlestick patterns and Bollinger example I used was the Japanese candlestick pattern called a Karakasa. I'm not really sure why I picked that pattern. I think it may have been suggested to me by a friend, but in fact I just focused on that one pattern. For those of you that don't know, a Karakasa is a Japanese oil paper umbrella. These things are made out of paper and bamboo and with an oil like linseed oil. I believe it's actually tung oil that they use, rubbed into the paper. And whenever it rains or even on sunny days, you will see these umbrellas all over Japan. The women especially like to walk out when it's sunny using these parasols or karakasas as sunshades. So you see these very, very commonly in Japan. And in fact, at the end of the conference, they presented me with a Karakasa that all the presenters at the conference had signed. And I still have that Karakasa in my home. So this is what a Karakasa pattern looks like. Has a long lower whisker, shadow, tail, what have you, and a very short upper shadow, with a very small but not non-existent real body. So this is not a doji. If it were a doji, the open and close would be roughly equal. Here you have the open being slightly higher or slightly lower than the close. In the example on the left, we have the open being lower than the close. In the example on the right, we have the open. In the example on the left, we have the open being higher than the close. In the example on the right, we have the open being lower on the close. I went and defined these mathematically. I said that the Karakasa body had to be the entire height of the Karakasa had to be greater than the average 10-day true range, and the body had to be less than some percentage of the 10-day average true range. I think it was less than 10%, and the upper shadow could be no more higher than the height of the body itself. So I tried to come to a rigorous mathematical definition so that I could actually test this idea. So what did I find? I find a Karakasa on its own had only modest forecasting value. It was, in fact, statistically significant only like at the 90% level. So it didn't have tremendous forecasting value on its own. Therefore, it wasn't really useful just as a single bar pattern. I also found that it was more useful if one counted a number of bars before it. That is, if one encountered a Karakasa after an uptrend, that had significant forecasting value. If one encountered a Karakasa after a downtrend, again, that had significant forecasting value. And that got me to thinking, well, aren't we really thinking about relatively high and relatively low again? So what about Karakasas at the bands? So in order to do this, I said that any part of the Karakasa could cross the band. It didn't matter how low or high it was. I personally preferred when most of the Karakasa was outside of the bands, but in fact, my rule for doing the analysis was that any portion of the Karakasa touched the band, that was a Karakasa at the band. And the fact that the Karakasa had little forecasting value on its own should not be much of a surprise, as very few single bar candlestick patterns have much forecasting value on their own. That is, just without any other context. So I went and tested, and I found that Karakasas at the upper or lower Bollinger Bands had significantly better forecasting power. In specific, I found that Karakasas at the lower band had more forecasting power than Karakasas at the upper band, but the Karakasas at both of the bands had statistically significant forecasting power. And just show you an example. I'm sure that we have some very short-term traders in the group here today. So I just highlight a couple of Karakasas here. The one I obviously like is this one. It occurs at the lower band and is a multi-period low. I just love to trade this pattern. Whenever I see it, I jump all over it. Here's an upside-down Karakasa at the upper band. It's not as dramatic a result as the other, but you'll see as you go through your price charts that when we get these Karakasas, especially this sort of formation at the lower band, that they become very powerful forecasting tools. So, whether one likes single bar patterns or more complex grouping candles, I apologize for the couple of typos in these slides. I wrote these last couple of slides just before the presentation here, and I hadn't had time to go back and proof them. So you'll apologize for my little typos there. I am a terrible typist, and I freely admit it. I am a better trader than a typist. So whether one likes single bar patterns or more complex groupings of candles, use Bollinger Bands to filter your actions. If you have a negative grouping of candles, whatever pattern it is that you like, that you think works for you, if it has bearish implications, I assure you that you will find that if it occurs at the upper band, it'll have greater forecasting power and a better risk-reward ratio than if it occurs, say, some nebulous place in between the bands, or even worse yet, at the lower band. So coupling this definition of relatively hot or relatively low with the definitions of future price action that we get from either single candlestick patterns or from groups of candlestick patterns becomes a very powerful concept. And if you look right here, you'll see in my background chart, you'll see a Karakasa at the bottom peeking through that right across the lower band here. I actually didn't see that until just this moment. So that's kind of fun. Of course, there's one that doesn't work just over here between the K and E. This gets you only a one-day rally, but for some traders, one-day rally is sufficient. So three strategies that I suggest for you employing Bollinger Bands and candlesticks. One, take sells at the upper band. Two, take buys at the lower band. And third, one that we haven't talked about yet, which I think is very powerful and very useful, is use bandwidth to detect areas of compression and then use your candlestick patterns to determine the direction of the probable breakout and take a position, early on in the process of the squeeze. Without doubt, the squeeze is the most valuable pattern, Bollinger Band pattern that, no, I shouldn't say valuable. Without doubt, it is the most popular Bollinger Band pattern, the one I get the most questions about. And people are forever asking me, what indicators can I use to determine which way we're going to break out from the squeeze? And frankly, I can think of almost nothing better than to find a really great candlestick pattern buried in between a set really tight bands and then following the forecasting implications of that candlestick pattern. So the bottom line here is you all really know about candlesticks already. I'm only bringing Bollinger Bands to the game, but I really think that Bollinger Bands can help by filtering and by identifying high potential zones like the zone of the squeeze. So here's some websites that you can take a visit if you want to see some of our analytics and some of the work that we do. BollingerBands.com is our main website. It has all of our information on it. bbands.com is our analytics website. That's where all our charting and filtering is. That's where you can find lists and portfolio management, such like that. We have a website dedicated to foreign exchange. That's BB4X. And we have a website that's dedicated to industry groups and market sector analysis, and that's grouppower.com. But if you're only going to remember one website out of this entire list, come visit us at bbands.com. You can have a 30-day free trial for nothing. Bang around the site and see if we don't have tools that you find to be of interest.